Let's talk about the U.S. labor market right now. We have had some numbers now indicating some softening over the last 2 or 3 months, actually. How concerned are you, or should we be?
Well, actually, we've had softening over even the past year. If you look at the number of jobs created on average, it was substantially lower last year than in the previous several years. How concerned should we be? We should be somewhat concerned. It's not a great thing, obviously, to have the unemployment rate going up, to have the number of jobs going down. None of that can be viewed as good. Obviously, you still have had, so far anyway, very strong GDP growth, so that is in some ways an even more important indicator. But yeah, it's definitely of concern.
As you say, GDP is growing from the numbers we've seen so far. I've heard 2.5%, 3%, something like that. And we are not creating as many jobs. Is that a shift in the economy about how many jobs we need to have the same output?
Well, obviously, just the simple math is when those two things happen, you get a productivity increase, and that's a good thing. Productivity increases are really what makes the economy more prosperous for everybody. You can't have real incomes go up without productivity growing. In terms of why is this happening, why is this disconnect happening at this time, there are obviously a bunch of theories. One is AI, which we can come back to. But I think it's absolutely true that companies are battening down the hatches. They are nervous about the tariffs. They're nervous about the uncertainty. There was a huge amount of hiring that went on post-COVID when it was hard to find workers. People took whoever they could get, and so they're trying to right-size all that. So I think that's really what's mostly driving this.
Employers are worried about the tariffs, but also they've had to pay tariffs, and it's been a difficult thing to pass all along to customers. So is it possible the tariffs are actually helping on the productivity, ironically?
Helping on the productivity and hurting on the jobs, because basically when companies do have these tariffs that they have to pay and then pass on, they look at other costs and say, what other costs can we cut? And if people are part of it, then they cut the people.
Some of the job growth we've seen has been in healthcare. In fact, a month or two ago, it was all in healthcare. What does that tell us about where our economy is headed? Because we're not really growing jobs almost at all outside of healthcare.
No, in fact, manufacturing jobs were down last month, and they've actually been down pretty consistently over the past year or so. And of course, a lot of people worry a lot about manufacturing. The healthcare jobs, on the one hand, are perfectly good jobs. We need people to be everything from nurses to doctors to whatever in the healthcare system. But on the other hand, you could make an argument they're not really producing anything. They're taking care of us as we get old, as our society gets older, and we need more and more health care. And so we should also want a more balanced job creation picture in which jobs are being created and all sorts of other things, including manufacturing, including services.
How does immigration factor into the labor market at this point, if at all? We obviously don't have the same immigration coming in, and there are some reports that people actually may be leaving the country. Is that affecting the labor market?
I'm a bit of a contrarian on this. The narrative is, yes, it's affecting the labor market, and particularly from people who are pro-immigration. They say, see, we got to have more immigration. And I'm in favor of more immigration. But it's very hard at the moment to see a lack of immigration as the reason here. You have labor force participation going down. You have the number of job openings going down. You have the number of the unemployment rate going up. So you have a whole bunch of other things that suggest that this is just a very loose jobs market. And also, when you look at CEOs on their quarterly earnings calls, they're not saying it's hard to find people. Nobody is saying that at the moment. They're in fact talking about how many people they're cutting.
You mentioned AI. Does AI factor in at all yet?
Well, if you look at something like manufacturing, I think pretty obviously it doesn't have anything to do with why we're losing manufacturing jobs. I think it is having at least some anticipatory effect in the sense that companies are saying, we don't need to hire as many engineers this year because we're going to have AI doing more of this stuff. We don't need to hire in the financial services world as many new entrants into our staffing because we're going to have AI doing more of this stuff. So I do think it's having an anticipatory effect, although I'd be the first to say I don't think it's actually changing the number of people working at the moment.
As an investor, how do you take into account the labor market? How does it affect how you position your portfolio?
I don't think the labor market per se is really that much of an issue for us. I think we would worry about a couple of things. One, the overall state of the market, and when you have rising unemployment and rising inflation at the same time, which we may have, we're going to get a few more reports, then that's getting perilously close to stagflation, and that is really bad for the market. The Fed, it's bad. It's tough for the Fed. It's bad for the market, and so forth. And then there are certain sectors, particularly software, where the anticipatory effect again of AI seems to be the greatest, and so it becomes fairly perilous to work your way around the stock market under that circumstance.
Stagflation is the thing that all economists say we have to avoid. That's really dangerous for us. What can we do at this point? By we, I mean the government or private industry. What can we do to really avoid the risk of stagflation?
Getting rid of the tariffs would certainly be a good start in terms of reducing costs for business, and therefore they don't have to raise prices quite as much. Beyond that, I'm not sure in the short run there's that much we can do. In a longer run, you want to have a more flexible economy, you want to deregulate, you want to try to make it more competitive, things like that. But in the short run, you sometimes get in this box that we may be heading toward.
What does this mean for the Fed potentially? I mean, how do they address this? We're going through a transition, obviously, with the chair of the Fed, but how do they address the situation where we do have growth, we may have a softening labor market, and there's concern about basically inflation at the same time that we have slowing growth?
It's tough for the Fed. They have a dual mandate, as you know, where they have to focus on both unemployment and on inflation, and so you can't necessarily do both things at the same time. There's a Fed meeting in the middle of March. The anticipation of further rate cuts this year has already dropped a bit in part because of the war and the effect on oil prices and how that's going to pass through into inflation. And so the Fed's going to have a tough decision. I think it's highly unlikely, almost implausible, that they would raise rates at this point. The question is, how much do they cut them? It had been expected they would cut them twice this year. I think that may become one. It may become none before we're done. But that's the range of possibilities.
There's some nervousness in the market these days about private credit, which sort of is an adjunct to the AI investment that we have. Is it a real problem as you look out at the credit markets? Do you think there's a real issue there?
I think there's definitely going to be some pain. I think there were a lot of loans made to particularly software companies, what we call ARR loans, where they were made annual recurring revenue. They're made on the basis of revenues as opposed to profits. Revenues don't necessarily mean you're solvent, they just mean you have revenues. And so those kinds of loans, and this happens in every cycle. I don't mean to be blasé about it, but it happens in every cycle. So I don't worry too much about private credit. There's going to be pain, but the system is not as leveraged and not as sort of badly engineered as it was in 2007, 2008.
You've got investments that you don't get mark to market every single day.
Oh, yeah. Yeah.
So how do you make sure that you get the right data? I mean, we see that in all sorts of places, including China. Sometimes people say, I'm not sure if the data coming out of China is reliable. How do you know that your risk data is reliable?
We don't necessarily know it on a day-to-day basis, but we watch the companies carefully. We have an idea as to what would be good or bad for them. And we do get quarterly marks, and we get financial statements, and so we can try to analyze the quarterly marks and see if they're accurate or not. But given that they're private investments, there's not usually a whole heck of a lot we can do about it anyway. And so we just try not to make new mistakes and live with our old ones.
We have a new risk right now, which is the war with Iran. Has that taught us anything about safe havens? I mean, if you look what's happened to the dollar and what happened to the U.S. Treasuries, it's interesting what's happened, actually. Treasuries sold off to some extent. People went to the dollar. Are the nature of safe havens changing?
That's a great question. I think the dollar is a safe haven, and most people see it, and as you said, that's probably what we've been seeing. I think treasuries are more complicated because the war creates inflation, and inflation is bad for treasuries. And so you could argue that that's why treasuries should sell off in this set of circumstances. But it's been an odd situation because gold until recently and silver also until recently have been so strong that those are normally indicators of a lot of fear out there in the market. But the market has been pretty stable, even with the last week or two of commotion. It's been pretty stable, all things considered. So it's something people have been puzzling over, which is why, on the one hand, why people have been going to these things like gold, but on the other hand, they still appear to be very much invested in stocks.